All right, so welcome back. So in this training, you're going to learn about annuities. Now we're going to dive deep into annuities because here's the thing: annuities is one of the most difficult parts of the life insurance exam. Most students who fail actually perform poorly on the annuities section of the life insurance exam. So this is a very long training. So we're going to divide it into multiple parts. Okay. So strap yourself in. Make sure you have a pen and paper or your notebook to take notes. Watch the entire thing from beginning to end. If you're listening on the podcast, you want to listen to the entire thing from beginning to end. So see you in the training.
Okay, so number 5, right there, it says an annuity differs from life insurance primarily. So on your exam, sometimes you have 2 correct answers, but what they want is the most correct answers, right? So in this case, let's start with A. Life insurance creates an estate, annuities liquidate an estate, right? That is true, right? But the key word here is primarily. So what is the main difference? So when they ask for what is the main difference, they're like, what is the main use of life insurance and annuity? Like, what's the main difference, right? So yes, life insurance can create an estate. We said that. And annuities can liquidate an estate. We said that. But annuities insure against living too long. As we said, annuities, it's meant to give you income for the rest of your life.
Yeah.
So, and then life insurance protects you against dying too soon. So let's break this down. You know, I've gone to Walmart sometimes, right? I'm sure you shop at Walmart. You know, so I go to Walmart sometimes, and you see these very old people, like they look like they're in their 80s, right? Like you can see them, you can tell that they're very old, right? These are not people that you should be working. But you see them working at Walmart, you see them pushing cart, and you feel bad for them. You tell yourself, damn, this person is too old to be working.
Good.
The reason they're working is because they probably save for retirement, but they ran out of money. So now in their old age, they have to go back to work. What annuity does is protects you against living too long, because you may be one of the lucky ones that lives until age 90, age 100. What if you run out of money? Right? Because the average life expectancy is, I think, around 75. But what if you live until age 95 and you run out of money? Then what? Then you either end up homeless or you end up working at 80 or 85 years old at Walmart. So annuity say, we're going to give you money for the rest of your life, as long as you live. So what that means is now it protects you against living too long. So if you live too long, you don't have to suffer. That is annuities. On the other hand, life insurance protects you against dying too soon, because we know that life itself is a risk. Every day you wake up, you get out of your house, it's just by the grace of God, right? You know, you go to work, and some idiot can say, you know what, I'm tired of living. They take a gun and shoot everyone, and that's your last day. Or you could be driving, you follow all the traffic rules, you're not speeding, you obey all the traffic laws, you have your seatbelt on, and some idiot is driving drunk, boom, comes and hit you, and you're done. That's how I lost one of my best friends, right? He was driving, he was parked at the stop sign, and someone was drunk in an SUV going at a very high speed, and just boom, and he died on the spot, right? So the point I'm trying to make is you can do everything right, and you can still die, right?
That's true.
So life insurance protects you against dying too soon. So what if you die early? Now your family depends on you, right? Maybe you got people in Africa that you send money to that depend on you. Maybe you got family here in America that depends on you, for support, right? You have children, maybe you got parents that depend on you. What happens to those people when you die early? So life insurance is going to protect against the financial risk, because when you die, that's a financial loss. You used to make $50,000 a year. You used to take care of your parents, take care of your kids, take care of your husband. Now you die, boom, no more 50,000. That's a loss to your family. So life insurance now will replace your income and give them whether it's 500,000 or 1 million. So what that means is it protects you against the financial risks of dying too soon. So what I recommend to clients is usually get both life insurance and annuity. Now, I think life insurance is more important than annuities because if you only had to pick one, then pick life insurance. But if you can get both, right? Because if you die too soon, life insurance will take care of your family. If you live too long, annuities will take care of you. Boom, problem solved, right? So that is the primary. When I say primary, what is the main purpose of annuity? So although A is right, but the key word here that maybe you didn't pay
It's
attention to
primary.
is primarily. So B is the correct answer. Now let's break it down. Let's come here to C. C says annuities guarantee death benefits and life insurance guarantee income for life. It's the opposite. You see how they switch it around?
Yeah.
So life insurance guarantees death benefit. Remember, we said that the main purpose of life insurance is to pay death benefit. That is the main purpose. Now, life insurance can be used for a lot of other things, but the main purpose, write this down because this will be on your exam. The main purpose of life insurance is to provide a death benefit so that when you die, money goes to your family. Whether it's 10,000, whether it's 100,000 or 1 million, money goes to your family. That is the main purpose of life insurance. Annuities, on the other hand, the main purpose is to give you money for the rest of your life that will protect against death. Now, there are some annuities that if you choose, they can give you income for a specified period of time, maybe 10 years or 100, or 20 years. But the main purpose of an annuity is to give you income for the rest of your life. Now, we come here to option D. Life insurance premiums are always, anytime you see always on the exam, read it carefully because always, most of the time, is wrong. When they say always or, most of the time, those blanket statements, they are wrong, right? So life insurance premiums are always higher than annuity premiums. That is false because you can get a term insurance for very cheap. You can get a term insurance depending on your age, right? Okay, for you, you're 30 years old, you're a woman, right? So you can get a term insurance for as low as even $20 a month, $20 a month. You can get a 200 or 500,000 policy for $20 a month. Whereas for annuities, you're not going to get any annuity for less than $100 a month, right? So life insurance premiums sometimes can be higher, sometimes can be lower. Like if you get a index universal life insurance policy, you'll be paying at least 150 or between 150 to 500 a month, right? So it depends on the type of policy you get, right? So it's not always, the key word here is always, right? It's not always. Sometimes life insurance premium can be higher, sometimes it can be lower. So again, remember what we talked about earlier? I went over the difference. We broke down the difference between life insurance and annuity, right? So this question now requires you to understand the difference between life insurance and annuity. So make sure you understand this because this is the difference between life insurance and annuities.
Did you know?
This is that 98% of our students pass the life insurance exam. Do you know what the national pass rate is? 50%. So no matter how many times you failed your life insurance exam, no matter how old you are, no matter which part of the country you are from, we can help you pass your life insurance exam. So if you want to pass your life insurance exam without stressing, then enroll.
Okay. All right. So let's go to number 6. Well, before we go to number 6, any questions?
So we say, and the main purpose of annuity is to provide income for life.
Yes.
So, but there's something that you add after it because to make the difference between life insurance, because you say that the main purpose of life insurance is to give money to, the main purpose of life is to give money to your family even when you are died. By income.
Yeah, it's to provide a death benefit. And by providing a death benefit, it protects you against living too long.
Okay. Okay. Thank you, sir.
All right. Let's go to number 6. So number 6 says, which statement? Oh, you know what? I like you to read the I'd like you to read the answer. So let's come here.
The question first.
Yeah, we've already done the questions, but I want you to read the answer.
5.
All right, so go ahead and so read number 5, the answers.
Life insurance protect against premature death. Dies too soon. Why annuity protect against longevity risk? Living too long. Option A is a partial true but not as precise. Option C and D are simply incorrect and means to confuse.
Okay.
Wow.
All right, so let's come back here. All right, we'll come here to number 6.
Mhm.
So number 6 is, which statement is true about suitability requirements in annuity sales? So first of all, what is suitability? Suitability pretty much means that whatever you're selling your clients, whether it's life insurance or whether it is annuities, it has to be in the client's best interest. Because sometimes what agents will do is they'll sell policies to clients that has the highest interest, that has the highest premium, right? Because the higher your premium, the more commission the agent will make. So even though the client can afford maybe 500 a month, but the agent figures out, then if I sell 500 a month policy, I can make $2,000 in commission, or I can make 5,000 in commission. So they'll go all out to convince you to do that, even though it's not your best interest. What suitability means is that you have to do what is right for the client. There are some things you take into account. Suitability means it has to be suitable, it has to be right for the client. So, for example, affordability. Can the client afford what you're selling them? Right? Can the client afford what you're selling them? And what I like to do usually is a simple test. My test is this: if the client lose their job for 1 year, the client is unemployed, will they still be able to make that premium payment? If the answer is no, the client can afford it, don't sell it to them. If the answer is yes, you sell it to them. Again, simple. Again, this will not be on your exam, but this is how I do business, right? I ask myself, what is 500 a month or 200 a month, whatever it is, the premium. I ask myself, because we do a financial analysis, right? You ask the client how much they're making every month. You ask them what's their debt, you ask them what's their financial goals, all these things, right? How much they have in savings, what's the emergency fund, all those things you ask them. So based on that, I will now ask myself, if the client gets fired from their job tomorrow and they can't work for 1 year, would they still be able to pay this premium payment, make this premium payment? If the answer is no, it's not affordable, right? So you have to make sure your client can afford the policy, because sometimes agents will sell policies to clients, and then maybe after 3 or 6 months, the client loses that, and then all that money they pay goes to waste. So you don't want to be that. So what suitability means is that make sure that product you're selling to the client is right for the client. What they say right for the client, number one, is it in line with the client's financial goals? For example, someone may say, you know what, right now I don't care about savings in life insurance. I don't care about all I want is just maybe $100,000 to pay for the mortgage when I die, so my children don't have to take over the mortgage, right? That's so I don't care. I have my big house back home in Africa. I'm going to move there. I got everything. Okay. Now the client says that right now you're going to sell them, you know, 1,000 a month premium IUL. That's not in line with the client's goals, right? Now, if the client tells you, oh, you know what, I want to get X amount of dollars, and I want tax-free retirement, then it makes sense. But the client is simply, they don't care about all of that. They just want life insurance. They don't even want, they just want to cover their house, right? So whatever you sell the client, it should be in line with the client's financial goals. Number two, it should be affordable. Number three, it should be what the client needs. Because even though whatever you're selling is a good product, but does the client need it? Right? Does the client need it? For example, it won't make sense to let's say someone is a mother and she has 5 kids. It won't make sense to sell her a 2-door car, right? Because she has 5 kids. So maybe what she needs is a minivan, right? Because you need a minivan to put all those kids in, right? So it won't make sense to go and sell her, like a 2-door car. You sell her a minivan because that's what she needs, right? So it's what the client needs. It's not what you want, but what the client needs, right? So that's what suitability. Make sure that what you're selling the client is better than. That's what suitability means. Now, let's go to the option. Let's start from bottom up. So D says once the client signs, suitability is no longer relevant. That is incorrect, right? Suitability is always relevant. That's why you do annual policy reviews. So every year, you meet with your client, you go over it. Maybe the client needs change. Maybe they need to increase their coverage. Maybe they need to get more. Maybe they need to get less, right? So suitability is not just a one-time thing. It's always ongoing. So D is wrong. C, suitability rules require recommending the contract with the highest commission. No, absolutely no, right? Again, recommending the client the contract with the highest commission is good for you, the agent, because you make more money, but it's not good for the client, right? So we know that C is wrong. Then let's come here to A. Suitability only applies to variable annuities. No, write this down. Suitability applies to all insurance products, whether it's life insurance or annuities or final expense, life, whatever it is, any type of insurance products, suitability applies to it. All insurance products. All insurance products must be suitable for their clients. Let me repeat. All insurance products, whether it's life insurance or annuity, all insurance products must be suitable for their client. So it's not just for variable annuity. So correct answer here is B. The producer must ensure the annuity aligns with the client's financial objectives and risk tolerance. So for example, if someone is afraid of losing money, then don't go and get them a variable annuity, because we'll talk about variable annuities later. But a variable annuity, you can lose money in your variable annuity. It's almost like the stock market, right? You can make a lot of money, but you can also lose a lot of money. So if someone is afraid of losing money, their risk tolerance is very low, don't get them a variable annuity, right? Recommend fixed index annuity, because with a fixed index annuity, you're not going to lose money, right? Your money doesn't go down, it always goes up, right? So the same thing, if someone wants life insurance, they want a cash value life insurance, and they're afraid of losing money, don't get them variable life insurance. Get them index universal life insurance, because with index universal life insurance, you don't lose money. Your money can only go up, not come down, right? So you have to know what the client's objectives are and what are your risk tolerance. All of that will go into suitability. What is right for the client? Now, let's read the answer. So number 6, read number 6, please.
Suitability standards require producers to ensure that the annuity meets the client's financial objectives, age, and risk tolerance. It applies broadly to all insurance products, whether it's life insurance or annuity. All insurance products must be suitable for their clients. So it applies broadly to all insurance products, whether it's life insurance or annuity. All insurance products must be suitable for their clients. So not only to variable annuities. Option C and D reflect on ethical or illegal practice.
Mhm. Okay. It is unethical and illegal because you have to put your clients' needs first. So C and D, you are putting your needs first. It's unethical and illegal. All right. Any questions?
So I want to understand stability. So when you approaching the clients, so you need to make sure first of all that
Mhm.
the client has the potential to pay the premium.
Exactly.
That's it. And then you talk about firing. If in any means maybe he lost his job or something,
Mhm.
is he gonna still keep paying his premium? So
Mhm.
in that case, that maybe the client already pay like maybe 5 times premium,
Mhm.
and then he lost his job.
Mhm.
Maybe 2 years later, he can't afford, or 4 years later, he can't afford to pay the premium. What
Mhm.
will happen?
Oh, good. So with the way
It's
insurance,
gonna be lapse or
yeah, the policy will be lapse. So when the insurance cancels your policy, then that's called lapse. So if you can't pay your premium for more than 30 days and it is not a, and okay, you have two types of, which one are you asking? Are you asking about annuities or are you asking about life
let's
insurance?
talk about annuities. Yeah.
Okay, annuities. So with annuities, the good thing about annuities is that it's not life insurance where if you don't pay your policy, your premium your policy will lapse and you lose all that money, right? Because life insurance, you can put $10,000 in your life insurance. If you start paying your premiums for more than 30 days and you don't have money, assuming it's a permanent life insurance, you don't have money in your cash value, then you lose all of that, right? The good news is you have 3 years where you can reinstate that, and we'll talk about that later. You can apply to get your insurance back. For annuities, you don't have to worry about that. So if you start paying your annuity premiums, one or two things can happen. If it's for a long time, the annuity company can decide to cancel your policy, your contract, and give you back the rest of your money. Or sometimes they'll have a grace period there, like if you don't pay your premiums for a certain number of time, your policy will still be active. But it's not going to be forever because when you get the annuity, you sign up, upfront in advance how long you're going to be paying this for. Like I'm paying 500 a month for the next 10 years, or I'm paying 500 a month for the next 20 years.
Mhm.
So if you don't pay, the second thing that could happen is now they won't cancel your policy. But let's say if you are supposed to get 400 a month for the rest of your life, but now you only, you start paying for 2 or 3 years, that means you have less money there. Now instead of 400 a month for the rest of your life, now maybe you get 200 a month. So it will decrease the amount of money you receive during the annuity.
Every month.
Yes, that's one or two things that will happen.
And then there's this thing when they were selling me the life insurance. They
Mhm.
say after when you pay your premium, so they always put your premium in the market to sell, like in the stock market or something like that, so that you can go interest. So
Mhm.
after 4 years, it means that you have a lot of money that you can even take a loan
Mhm.
out of your premium. But now, if I want to take this question to life insurance,
Mhm.
why can't they take the interest that my money have made to pay my premium? That in their case, that I'm not able to pay
Okay, no, you asked a
premium.
very good question, and that's just how the life insurance business model works, right? So assuming you get a permanent, because we have two types of life insurance. We have term insurance and we have
Mm-hmm.
permanent insurance. We'll talk about that when we get to types of life insurance policies.
Okay.
If it's, I'm assuming you're talking about a permanent life insurance policy, and you got two major types. You have universal life and you have whole life, right? And then under universal, you have universal life, you have variable universal life, you have index universal life. So the way it works is that if you got a permanent life insurance policy, they'll guarantee you a fixed interest rate, right? Assume it's not variable, right? They'll guarantee you a fixed interest rate. And that fixed interest rate, let's say 5%. So, but on the market, let's say the insurance company got 12% interest that year. Well, 12 minus 5 is 7%, right? So the insurance company gets to keep the extra 7% and give you 5%. But on the other hand, the good thing is you know that you're never going to lose money. You're always going to get your 5%. But what if, let's say the stock market does very poorly that month and the stock market lost, let's say 20%, so there was, the market went down 20%. So now instead of your account value going down by 20%, you will still go up by 5%, right? Because they guarantee you that 5%, no matter what, you get 5%. So the insurance company is taking a risk. If the stock market does better than 5%, it's a win for them. If the stock market does worse than 5%, it's a loss for
You
them.
see,
You have nothing to lose because you guarantee your, that is how the insurance
5%.
company stays in business. Because at the end of it, know that it's still a business, right? So business, you're in business to make profit, to make money. So that's how the insurance company makes their money. Yeah. So it's
Okay.
just the business model. Yeah.
Pay information.
So number 7 says during the accumulation period, premiums paid into an annuity A are immediately distributed to the annuitant. B,
No,
grow tax deferred until withdrawn. C,
no.
are always tax-free at distribution, and D cannot be surrendered. So again, let's start from
Mm.
the bottom up. D cannot be surrendered. No, 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 no. So what does surrender mean to you?
Surrender means D cannot be during the accumulation period, the premium pay into annuity cannot be surrendered.
So
Maybe
what does
cancel.
perfect?
Surrender means
So
cancel.
perfect. I like that. So surrender means when you cancel. Again, on your exam, they're not going to use the word cancel. They're going to use insurance terms to throw you off, right? So just know that surrender is the insurance word for cancel. So anytime you cancel, it's called surrender. If the insurance company cancels your policy, it's called lapse, right? So what this is saying is during the accumulation period, premiums paid into an annuity cannot be surrendered. That is false, right? You, as the owner of that annuity, you can choose to surrender your policy at any time, whether during the accumulation phase or during the payout phase. You can choose to cancel it at any time, right? So we know that that is not correct. Now, let's come to C because you selected C. So the answers here in blue, the ones highlighted in blue are the ones you selected, and then the ones in green are the correct answer. So C says, are always tax-free at distribution. No, at always tax
Contribution.
contribution. No, 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 no. Remember, we're comparing life insurance and accumulation period, and we say it's
Utilization.
deferred, right? So the money you put in your annuity during the accumulation period is always tax deferred. Tax deferred means they're not taxing you now, but when you go to take it out, they will
Your
tax you,
tax.
right? Exactly. So during the accumulation period, your money you put in there. Another name for the annuity period is for the accumulation period is contribution period. I forgot to add that. Let me add it here. Another name is the contribution period.
Let's during the contribution period, there's not tax. It's not taxable. That's why they say tax deferred. But
Yeah,
it's during the payout that is taxable. That
exactly.
is why I select that question.
Huh? You see what?
That is why I make the mistake. I select the answer.
Yeah, no. So you're not paying any taxes when you're putting money in, right? Only time you pay taxes when you go to take that money out. So you're not paying
Then they
any.
say
Mhm.
are always tax free at
So
contribution.
again, remember, contribution. What does
Every question have always and only
what does
is
what does
false.
contribution mean?
Is pay in.
Okay, so it's no, it's not tax free. It's tax deferred. So yes, you are not paying taxes on it, but just because you're not paying taxes on it when you put it in doesn't mean it's tax free. It's tax deferred, meaning like they postpone the tax payment. So there's a difference between tax free and tax deferred. Your 401k is tax deferred. It's not tax-free. Just because you're not paying taxes now on your 401k doesn't mean when you go to take it out, you're not pay. You pay
No.
taxes when you go to withdraw your 401k, right? But when you're putting money in, you pay tax.
No?
Exactly. It's the same thing for your annuity. When you're putting money in, you're not paying tax, but it doesn't mean it's tax-free. Tax-free means that when you go to take it out, there's no tax. But when you go to take it out, they'll tax you, right? So it's tax-deferred, meaning that there's pausing taking taxes for now, but when you go to take it out, you will pay taxes. So
Okay,
it's not
taxes.
tax-free, it's tax-deferred. Okay, so that's just a little terminology that will confuse people. Tax-deferred is not the same as tax-free. Both of them, you're not paying taxes. But tax-deferred, you pay taxes when you go to take it out.
When you go to withdraw.
Tax-free means that when you go to take it out, you will not pay tax. That's the difference.
Yeah.
Any questions?
No, that's fine.
All right. So we say again, anytime on your exam, most of the time, about 70% of the
Yes.
time when you see the word always,
And only.
most of the time it's wrong, right? So the fact is, so anytime you see always, only, those absolute terms, you want to slow down and read it one more time. Yeah, so this is saying during the accumulation period, premiums paid into an annuity are always tax-free. No, it's tax-deferred, not tax.
That's different.
So that was, I think the tax-free is what tripped you up, right? And contribution, again, another name for the accumulation period is contribution period. Okay, now let's come here to A. Say A says are immediately
Immediately
distributed to
distribute.
oh, the only time it gets distributed to the annuitant is during the annuity period, not during the accumulation period. Remember, the accumulation period is where you're putting money in.
Yeah.
So correct answer here is B, grow tax deferred until withdrawal.
Okay, withdraw.
Any questions?
No, sir.
All right. Now you see your mistake, right? You're not going to make that mistake again, right?
No way, no way.
All right. So now, in your own words, tell me everything you know about the accumulation period.
So talking about the accumulation period is first of all known as a pay-in period. So during the accumulation period, we talk about there's a fixed amount. So once you did not finish what they call fixed amount, you can't go to annuitization period. Accumulation period can be paid periodically. It can be made in single payment or periodic payment, something like that, if I don't mistake. What about accumulation? Accumulation period is tax deferred.
Okay.
So when they say tax deferred, it means that there's no tax at that moment that you are paying in the money. And then did I so far? Yeah, I think that is all for now.
Okay. Tell me everything you know about the annuity period.
Okay. Annuity period. Annuity period is a payout period where the annuitant receive money from where the owner or the annuitant receive money from the annuity. So the period where the annuitant receive money from the annuity. So and then during the withdrawal period, there's a tax payment. What do you get? Annuity period.
So what are the other names for annuity period? 4 other names for annuity period.
Okay, it can be there's disturbance. This 4 other names for annuity period. No contribution. Distribution.
Okay, that's one.
Yeah, distribution. What again? So you say there's not disbursement, something like that.
Period, that's 2. Okay, 2 more names.
Yeah. Um, Give? No. Surrender? No. I don't know the two others, sir.
All right. Remember we went over this. I told you to study this, right?
Okay, yeah.
Yesterday.
Yeah, I went through this one. Distribution phase.
So another name for the annuity period is annuitization period, payout period,
Oh,
paying out
okay.
distribution period or distribution phase, and disbursement. And we said that accumulate.
Disbursement. Okay. Mhm.
Okay. All right. So let's come back. So what happens
Another name for accumulation period, what is it?
is contribution period when you're contributing money.
And paying.
Okay. All right. So let me explain this. And for those of you watching, again, this is a good opportunity. You can pause the video in your own words, explain the difference between accumulation period and annuity period, because this will be on your exam. So let's go ahead, right? So we said that in life insurance, in annuity, you have two periods or two phases. Sometimes on your exam, they'll say phase or they'll say period. It's all the same. You have your accumulation period and you have your annuitization period. So let's say I have this glass. This glass is empty, right? So when you get an annuity first, your annuity contract is empty. But now you start to put money in. You can either put money in all at once, or you can put, you can make payment one time, or you can make a little bit of payment every single time. So every time you make a payment, boom, that's your payment. Then what happens? The insurance company will add a little bit of interest. Boom. You make a payment, the insurance company will add interest, right? So that happens. So while you're in the annuity, your accumulation period, what does that mean? Accumulation means to accumulate means to grow, right? You are getting. So now, for example, this cup is accumulating water and juice, right? It's accumulating, it's growing. So you keep doing that. The accumulation period is also called the pay-in period because that's when you're putting money into your annuity. You're paying money into your annuity. You're paying money into your annuity. It's also called the contribution period because when you're contributing, that means you're giving, right? If someone says, I want you to contribute money, that means they want you to give money, right? So you're contributing, you're putting money in. So during the accumulation period, because you're not taking that money, the money you're putting in, you're not taking it. Remember, the government always going to tax you. But because you're not taking that money yet, the money you're putting there will keep growing, but will grow tax deferred, meaning they'll defer the tax, they'll put off the tax. So you're not going to pay it now. But when you go to take it out, you're going to pay it. Now, during the accumulation phase, if the annuitant dies during the accumulation phase, and I hope you're writing this down because I'm going to ask you either that at the end of class today or tomorrow, or not tomorrow, we'll come back next week. I'm going to ask you, and I'm not going to rest until you know this. So during the accumulation phase, every money you have in there, you're entitled to all your money. Now, minus, sometimes the insurance company will have no fees they charge because it's a business, right? So you're entitled to all your money minus fees. So let's say if the annuitant dies, and we said the main purpose of an annuity is to pay money to the annuitant, right? So if annuitant dies, um, so if the
Beneficiary.
annuitant dies, if the annuitant dies during the accumulation phase, all money or account balance goes to beneficiary. So let's say the annuitant has $10,000 in their account, and then maybe they have 5% interest on that, right? So all that money plus their interest goes to the beneficiary. All right. While in the accumulation period, there is no guaranteed income, because the only time you get guaranteed income is during the annuity phase when they're paying you that money. There is no guaranteed income. Now, I gave the example last time, just like human beings, when a woman is pregnant, the child in that woman's womb is called what? Fetus, right? The unborn child.
Yeah.
But when that child is born, that child is now called what? A baby, right? So the process by which that fetus goes from being a fetus to a baby is called what? Delivery. Delivery is what transforms that fetus to a human being, to a baby. So too in annuity, the process by which you go from now, the accumulation period, to the annuity period is called annuitization. That process, remember that annuitization. You want to write that down. It'll probably be on your exam. Annuitization. The period where the accumulation period now gets converted into the annuity period is called annuitization. It's that process. So now once your annuity is annuitized, that means now you go from paying money into the insurance company, paying money. Now you've entered the annuity phase. Another name, we have 4 names for the annuity phase. It's called annuitization. Because on your exam, they may not have annuity phase. They may have disbursement phase. And you're scratching your head like, what is disbursement? So you got to know those names. Disbursement phase, distribution phase, payout period, annuitization period. All of them mean the same thing. During the annuity phase, any money you take out will be taxed. Your profit, not the money you put in. Your profit will be taxed. So let's say you put in $10,000, but now you got 5,000 profit. So your total account value is 15,000. That 5,000 profit will be taxed. We'll talk more about taxation when we get to the taxation of life insurance, right? We'll talk about the different types. You have something called LIFO, last in, first out, and FIFO, first in, first out. But I don't want to confuse you. We'll talk about that when we get to that part. So during the annuity period now, is taxable, but only your profit or your gain is taxed, and it's taxed as ordinary income. Now, remember we said annuity is a retirement vehicle. The main purpose of annuity is to give you money for the rest of your life, right? It's retirement, the same way you have your 401k, all of that. So if you take out your annuity early, before age 59 and a half, you'll be penalized 10%.
Oh, okay.
The 10% penalty is if you take that money, if you start taking that money out before age 59 and a half, you will be penalized 10%. Write that down, 10% if you take it out before age 59 and a half. The money during the annuity period, you have a guaranteed income. That's when the insurance company will determine, okay, based on everything, they'll ask you, which one do you want? Do you want income for life? Do you want income for only a certain period of time? You tell them what you want your payout period to be, and then they'll structure it. But now you have guaranteed income. So the guaranteed income occurs during the annuity period, not accumulation. Because income means money you're receiving, right? So the guaranteed income occurs during the annuity period. If you die as the annuitant, if you die during the annuity period, your beneficiary is not guaranteed to receive money. It depends on what settlement option you selected. If you selected life only, and we'll get to the types of settlement options later. I won't go into it too much because I don't want to confuse you right now. But if you select life only, if you die, your beneficiary, if you die, you select life only during the annuity period, you die, your beneficiary receives 0, because life only is only covering your life. When you die, no money goes to your annuity, annuity beneficiary. But if you select maybe life with refund or specified period, then whatever is left, your beneficiary gets. Again, I won't go into details for that one now. When we get to settlement options, which I think will be 6.2 or 6.3, then I'll go into details. So I want you to understand the difference between accumulation period and annuity period, because as I said, you have between 5 to 12 questions on annuity on your exam. Out of those 5 to 12 questions, one of them I guarantee will be on accumulation versus annuity period. So you have to understand this. Now, I'm going to ask you at the end of class, or when we come back next week, to explain the difference between accumulation and annuity. And I hope you're taking notes. Any questions?
I have a question.
Sure.
You didn't reply to the question that you asked me.
Mhm.
What happened to your money when you take out in amortization period?
No, that's what I said now. So the money you take out will be taxed. It's only your profit that will be taxed, not the whole amount. Because the money you already put there is considered is after tax, right? So it's your profits. Anything more than what you put in, that's what's taxed. And it's taxed, remember, it's always taxed as ordinary income, not capital gains. It's always taxed as ordinary income.
So the part that they call taxable, that is what they call ordinary income.
Yes, so you'll be taxed as ordinary income.
Did you know?
Is that 98% of our students pass their life insurance exam. Do you know what the national pass rate is? 50%. So no matter how many times you failed your life insurance exam, no matter how old you are, no matter which part of the country you are from, we can help you pass your life insurance exam. So if you want to pass your life insurance exam without stressing, then enroll in one of our online memberships or book a free one-on-one consultation for more information. Now let's get back to our training.
Okay. So let's go back here to our questions. So can you please read number 7 for me? Number 7 right here.
Number 7, premier accumulation with tax deferred growth during the accumulation period. Withdrawals or surrenders are taxable on the earnings portions.
The earnings means your profits.
Okay.
Okay.
Option A, C, and D are incorrect because contributions are not tax-free, nor are they immediately distributed or permanently locked.
Okay. So the contributions are not tax-free. It's just tax-deferred. Tax-free means you never pay taxes on it, but we said that that is false, right?
Mhm.
When you go to take out the money, that's when you pay taxes. All right. Now let's go to question number 8. All right, question number 8. So number 8 is a deferred annuity funded with a single premium and annuitized 15 years later is best described as. Okay, so you got this one right? So, no, but let's just go through the options anyway. D says an equity index annuity. It says here deferred annuity funded with a single premium and annuitized 15 years later is best described as. There's nothing there. I mean, there's nothing here that says is equity index, right? Again, when we get to you have fixed annuities, you have variable annuities, and then under fixed annuities, you have equity index. Well, no, I think that's 6.2 or 6.3. We'll get to that one, but it's not equity index, right? It's not equity index. C says a group annuity. It's not group annuity. You can also have group annuities. The same way you have group life insurance, you can have group annuities where your insurance company or your company, your employer will pay for life insurance for you, right? So there are some companies that will pay for life insurance for their annuities for their employees, right? So there's group annuities. We'll talk more about that later. But it's not group annuities. A says a flexible premium immediate annuity. Remember, we said that immediate annuity means that you start receiving payments within what?
The first period, the first month.
Mm-mm.
The flexible premium, immediate annuity. Oh, you start receiving money before the 12th month, the 12th
Oh, no,
year, 12 months.
within 12 months. Anytime
Yeah, within.
within 12 months, it can be 1 month, it can be 9 months. But if you start receiving payments anytime within the first 12 months of getting that annuity, is called immediate. With it, if it's more than 12 months, or sometimes on the exam, it will say 1 year. 1 year, 12 months, all the same. If it's more than 12 months, then it's considered
Different,
deferred annuity.
different annuity.
What is the need for this? So we say, so you see, the person pay with single premium. So that's number 1. And he annuitized. Remember, I said annuitized is when you go from putting into taken out, right? So it was annuitized 15 years later. So 15 years later, he started receiving payment. So now the correct name, what type of premium? He paid one premium. So
Single
single premium.
premium.
Is it deferred or immediate? It's immediate. So it'll be single premium deferred annuity.
Annuity.
Correct answer is B. So you got this one right. So see, we've done 8 questions. Out of 8 questions you got so far, you've got 3 right and 5 wrong, right? So this tells me you still need some work on this. All right. But I'll see when we finish this, you have the 200 questions. I'll see how well you understand this, right? I expect, because on this, you score the annuities overall. Your overall score, I think, was around 30.
36.
Yeah, 30. Yeah. So now, when I give you the 200 questions, I'll expect to see improvement. I'll expect you to get at least 70%, minimum 70% with the explanation and everything, at least 70. If you can get at least 70%, that tells me that you're learning the material, you're understanding, and then we'll go over again. The goal is for you to score at least 90% on the annuity questions. When you score at least 90%, that tells me, okay, you really understand this. All right, so number 8 here says, which individual could be both the owner and the annuitant? Very important.
Yeah.
So which individual could be both the owner and the annuitant? So let's start from A. A says a corporation purchasing a retirement annuity for an employee. So know that the annuitant always has to be a natural person, okay? The annuitant always has to be a natural human being. It cannot be a corporation. So let me write it here on the annuitant.
So the annuity.
Yeah. The annuitant has to be, now your beneficiary for annuity can be a corporation, but the annuitant has to be a natural person. Must be, let me put this one in bold, must be a natural person, meaning a human being. You cannot name a corporation or charity or whatever as your annuitant, right? So we know that A is wrong because it says which individual could be both the owner and the annuitant. Now, the owner can be a corporation, but the annuitant, the person who's supposed to be, remember, this is for retirement, right? The purpose is to provide retirement income. So how will a corporation get retirement income, right?
That's
It's not a
impossible.
human being that can retire, right? So we know that
Mhm.
A is wrong. Let's come here to B. It says a parent buy an annuity for a child. Which individual could be both the owner and the annuitant? So if you're buying insurance for a child, no, if you're buying annuity for a child, but
It
you are
means that you're not the owner.
no, you are the owner because you're buying annuity. Whoever is buying it is the owner. But it says
Okay.
annuity for a child. That means the child
It's just an annuitant.
is the annuitant. But this question is asking who could be both the owner and the annuitant. So if you are buying it for the child, that means the child is what? The annuitant.
Mm-hmm.
You are the owner, so it cannot be, right? Now come here to D, an insurer holding the general account. No, it doesn't make sense, right? Because the insurer, if you are the insurer, you are selling the policy, right? So you cannot be the owner of the the annuity. If you are selling, if you are the insurance company, how can you own something you're selling, right? So that doesn't make sense. So the correct answer here is C, an individual purchasing an annuity on their own life. So if you buy annuity for yourself, you will be both the owner and
Mm-hmm.
the annuitant. But if you buy annuity for someone else, then that person will be the annuitant and you will be the owner. And know that corporations, or to be the annuitant, you have to be a natural human being. It cannot be a corporation. Now let's read the answers. Number 8. Okay. So can you read this for me, please? Number 8. The one highlighted.
Individual buying an annuity on their own life can be both owner and annuitant. In contrast, corporations and parents actually name someone else as annuitant. Insurers are never annuitants.
Aha. All right. Any questions?
No, so that one is clear.
All right. Good. So you got that one right. I won't spend too
Mm-hmm.
much time on it. All right. So we'll go here to number 9. Number 9, if an annuity owner dies during the accumulation period, the beneficiary typically receives a. All right, so let's break this down. So we'll start from D. No, or let's start from A. If an annuity owner dies during the accumulation period, right? And remember, I talked about this not too long ago, right? So
Mhm.
if the annuity owner dies during the accumulation period, the beneficiary typically receives, it says only the premium paid without the interest. No. Remember I said the beneficiary will receive if if the annuitant dies in the accumulation period, the account balance goes to the beneficiary. So the account balance will be both premiums, total premiums
And the interest.
plus interest. Okay, and then if there's any if the maybe while the annuitant was alive, maybe they took out, maybe the policy owner took out maybe a loan or withdrawal. So whatever the owe will be subtracted, but you will get the premiums, the total premiums and interest. So this is only the premium. Again, as I said, on your exam, most of the time we see the word only, always. About 70% of the time, that's a wrong answer. So if you have to guess, just guess that it's wrong. most of the time, that's a, so only the premiums paid without interest. We said that's false. Let's come to C. A tax-free lump sum equal to the owner's basis. This
So
sounds,
what do you,
this sounds correct, right? But
yeah,
remember,
because of tax free.
tax-free, no, what tax-free too is not bad because it's lump sum equal to the owner's basis. So what does basis mean? In life insurance, basis just means your own money you put in, right? It's your own money you put in. So basis just means your money you put in. So when they're trying to determine how much you owe in taxes, they look at how much more is above your basis. So anytime you see basis or cost basis, it just means your own money. Your own money.
Mhm.
So this is saying a tax-free lump sum equal to the owner's basis. No, you're not just going to. So yes, what you receive will be tax-free. What the owner put there will be tax-free. That's true. But remember, you also get the interest. So they didn't put anything here like interest, right? So this is partially true, but not fully true. Again, on the exam, they'll trick you. So some of the answers will be partially true, but it won't be completely true. So yes, you can get the lump sum equal to what the owner put in, but also plus interest. So it's the same thing here, but it same as A, but it just reworded. D says monthly lifetime income immediately. No. Mm-mm. No. Mm-mm. During the annuity, during the accumulation period, whatsoever the beneficiary had in there plus interest, you get. There's no lifetime income guarantee. The only person that's entitled to lifetime income guarantee is the annuitant. So
Yeah.
D is wrong. So correct answer
So,
is B, the greater of the contract value or total premiums paid. So if let's say the client pay $10,000, right? The total premiums they pay was 10,000 and they died during the accumulation period. So that means the 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 lowest you will get is 10,000. Or let's say that 10,000 with interest and everything now is 12,000. That means you get
mhm.
12,000. So correct answer is the greater of the contract value. The contract value is how much is in that account for you or the total premiums paid. So B is the correct answer. Any questions on that?
No, sir.
Okay.
Answers.
So let's go to the answer number 9. Okay, so you can read this for me.
Okay. Most annuities guarantees that if the owner dies during the accumulation, the beneficiary receives at least the greater of the premium pay or the current amount value. This ensures beneficiaries doesn't lose the original investment. Option A, C, and D are too limited or misleading.
Uh-huh. All right. Any questions on that?
Mm, no.
Okay. All right. Let's go to question number
10.
10. All right. So question number 10 says, why are annuities sometimes referred to as the opposite of life insurance? Let's start from A. They are regulated by different
Agency.
agencies. That is wrong, right?
Mm-hmm.
Now, that is wrong. Now, if it's If it says variable annuities, because all variable products are regulated by both the state insurance department and the SEC, the Securities and Exchange Commission. But in this case, they're just asking about just annuities in general. So they didn't specify, right? So no, annuities are regulated by the state insurance department. And it's the same state insurance department, the same state insurance commission that regulates life insurance, right? So it's the same. So it's no difference. C says life insurance pays only if you live. Annuities pays only if you die. They switched it around, right?
Yes, mm-hmm.
See what that means, right? So it's the opposite. Annuities pay only when you live, and life insurance pays only when you die. So they switch that. Okay. D says annuities are always more expensive than life insurance. Remember how I told you most of the time when you see always, only is wrong? So annuities are not always more expensive than life insurance. I know some people who their life insurance premium is $2,000 a month. Right? So sometimes life insurance can be more expensive than annuities. Sometimes like annuities can be more expensive. So it's not always. It just depends on the kind of policy. So correct answer here is B. Life insurance provides money at death, while annuities provide money for life. And you got this one right. Any questions on this one?
No.
It's straightforward, right? Okay. So now you can read the answer for So you can read the question for 10.
Mm-hmm. Life insurance creates an estate by paying at death, while annuity liquidate an estate by paying while the insured lives. That is why they are often called financial opposites. Option C and D are distractor and inaccurate.
All right. So now that concludes here section 6.1. So here, this is the live producer for Maryland. So now we finish section 6.1. So all those questions, those 10 questions, they cover accumulation period versus annuity period. It covers the definition of owner, annuity, and beneficiary. It covers insurance aspects of annuity, and it covers suitability. So those 4 topics were covered under 6.1. So now we'll move to 6.2. So 6.2 now we'll look at immediate versus deferred annuity. We'll look at like the single premium immediate annuity. We'll look at non-forfeiture, premium payments, surrender charges, dollar provisions, all of that stuff.
All right, so thank you very much for watching. If you're watching this on YouTube or if you're listening on the podcast, thank you very much. We are doing something amazing here. Our pass rate is 98%. So 98% of our students pass their life insurance exam with flying colors. The national pass rate is 50%. Last year, 200,000 people failed their life insurance exam. And some of those people who failed, some of them studied for up to 2 months. Some of them have a master's degree. So they didn't fail because they didn't study hard enough. They didn't fail because they were dumb. No, they failed because they didn't know the system, right? They didn't follow the system. And to pass this life insurance exam, there's a system. The good news is we've cracked that code to pass your life insurance exam. As I said, our pass rate is 98%. We've helped students pass their life insurance, people who have even failed their exam up to 7 or 8 times. They've come to us, we've helped them pass. We've helped people as young as 18 years old pass their life insurance exam, people as old as 67 years old pass the life insurance exam, people from almost every single state, from Washington to New Jersey, New York, California, you name it, all across the United States of America. We have helped people pass their life insurance exam, and you will be our next success story. So if you don't want to fail your exam, like 200,000 people last year failed their life insurance exam, then book a one-on-one consultation. That consultation is free, or you could just click the link in the description and sign up for one of our membership programs or sign up for our self-study. Until next time, we wish you all the best on your life insurance exam, and we wish you a successful insurance career.